Hello and welcome to the Private Capital Podcast. I'm Joe Riley. At our recent inaugural family office event in New York, we were very privileged to interview Zoe Cruz. Zoe is a prominent figure in the financial services industry, known for her significant contributions and groundbreaking achievements as one of the highest-ranking women on Wall Street. She was named one of the Forbes top 50 women in business 4 years in a row, with a career spanning over 25 years at Morgan Stanley, where she served as co-president. Cruz played a pivotal role in managing major revenue-generating businesses, starting with her taking charge of the FX desk in 1993. Currently, she's the founder of her own asset management firm, Menai Financial Group. This move not only highlights her resilience, but also her belief in the potential for growth and opportunity that can come from financial innovation. Zoe Cruz moved to the U.S. from Greece at age 14 and is a graduate of Harvard and Harvard Business School. As we engage in this discussion with Zoe Cruz, we will explore her insights on leadership, the challenges faced by women in finance, and the bridges from TradFi to DeFi. Please enjoy my conversation with Zoe Cruz.
This podcast is for educational and entertainment purposes only. Anything said by the guests or host should not be construed as legal or investment advice. Thanks for listening.
Could you start by telling us a little bit about your background?
Yes, it's the American dream story. My parents moved from Greece when I was almost 15. We moved to a suburb in Boston, blue-collar suburb in Boston. I didn't speak a word of English. And back then they had these programs that we were legal immigrants, I should say. They had these programs where they taught you English before you went to a public school system. So I took English for a year. Then I went to a public high school. And if it weren't for those two amazing teachers, my Latin teacher, they taught Latin in public high schools back then, and biology teacher who asked, "Are you applying to Harvard?" I had zero vision that I should be applying to Harvard. If they didn't care about that, my aspiration was to go to Boston College. It changed my life. I went to Harvard on a full scholarship and then to Harvard Business School. And I joined a great firm called Morgan Stanley. And the rest is history. I would say that I don't want to be falsely modest. Yes, I was smart enough. I worked hard, but there are a lot of people that are smarter than I am, work harder than I am, that didn't get the opportunities I got. Being in the right place at the right time is important, but also making some decisions that change your life. For me, I applied to Goldman, Solomon, and Morgan Stanley out of business school. I have one of my business school classmates here. And culture matters, so I chose Morgan Stanley because of the culture fit. It changed my life. So that's my story.
Tell us a little bit though about the culture shock when you came over here. What was it like to make that shift?
Yeah. You hear all these things where they become trivialized. It was heartbreaking. I came from a small town where it was much more important to be from a good family than a rich family. So we were a good family. You did the right thing. My dad believed in education. And you come here and you're nobody. And you speak not the language, the culture shock. It was painful. And as I said to a lot of young people that seek advice, you never jump off the ledge voluntarily. Somebody has to push you. In this case, my parents took me out of my comfort zone, where I was a great student. It wasn't hard to be a great student in the town I was in. It was painful, but the life lesson, and then at Morgan Stanley also similar life lesson, because I started in foreign exchange, even though investment banking is the division that made me the offer to go to Morgan Stanley. I got lucky to start in FX. You understand there is always another point of view. You don't pontificate about the way things are. I learned that what I learned in Greece was wonderful, but it was very narrow. I think that was a painful, but what a transformative experience.
But you started off with romance literature, correct?
Romance, languages,
that doesn't
and literature.
necessarily lead to finance nowadays.
Yes.
It used to.
Again, luck. My ex-husband, who I met in college, and we were married for 32 years, so even though the ending wasn't that pretty, but it was an amazing luck that I met this man, he's from Nicaragua. That's why the Cruz name I kept. My maiden name is Papadimitriou. Would you keep Papadimitriou? No. My entire career was Zoe Cruz. And he had planned his entire life. He was going to be a JD MBA at Harvard, which he ended up being. He was going to be in investment banking. So he asked me in college, what are you going to do with literature when you graduate? I said, I don't know. When I graduate, I'll figure it out. And back in those years, basically, they had these management training programs in banks, commercial banks, that took literature majors and turned them into bankers. Real programs for free. So I applied to New England Merchants Bank in Boston, which doesn't exist, but it was any longer. It was one of the top 3 banks, large influential banks in Boston. And I applied for that program. So I walked in and my ex-husband is giving me all kinds of advice about what I should say to get to that program. So I walk in and the HR person says, oh my God, you speak 4 languages. We have an opening in foreign exchange. You don't need 4 languages. Again, sheer luck. And so I started foreign exchange trading in Boston. Back when the world wasn't globalizing yet, it was letters of credit in some local businesses that you were hedging. I found it really amazingly interesting. But 3 years later, I felt investment banking is it. So I went to business school to be an investment banker. And again, when I joined Morgan Stanley, they were just starting the FX business. It was a small investment banking boutique, private company. It had 1,800 people. And they were setting up this business because prior to that, it was the commercial banks, Citigroup. It was the commercial banks that did FX. So the brilliance of these investment bankers that said we do huge M&A deals that are cross-border deals. Why are we leaving the bid-offer spread on the table for FX? So I started in that business. I was one of the founding members of that business. And the rest is history.
Who are the other founding members?
Paul Kimball. And again, when you think about those years, it was mainly men. The women were administrative assistants. And part of the reason I went to FX was because of my previous experience, but also I wanted to build a business. But I also realized, because I was already a working mother, I got pregnant second year business school, so I already started my career not having to make a decision. Should I have a child or not? So as a working mother, if you're trading, you either make money or not. There is no qualitative report cards. And in a meritocracy, which is what they say, meritocracy at Morgan Stanley, if you make a lot of money, they don't care if you have 3 heads. For me, we started at the same level, Paul Kimball and I. And at the beginning, he was promoted before I was. But at some point, I was a very profitable trader, and they didn't care that I was a little emotional, I was a little loud. I made them a lot of money.
Those are good qualities in a trader. Yeah. Along those same lines, who was most helpful to you in learning the ropes of FX before you founded the business?
I think, look, the most helpful managers in general, not specifically FX, are people that take a risk on you, let you run with the ball, are supportive if you fail. John Mack was one of the supporters. If it weren't for John Mack, I wouldn't have been running fixed income, FX, and commodities for Morgan Stanley. He took a risk because there were 3 other men that were the contenders to the throne. At that time, fixed income was over 60% of the firm's profits. So he took a risk. That's an example. So it's not just FX. I would say managers that take a risk, but are unequivocal about if you fail, next. Those are the good, to me, managers for talent.
What were the formative lessons you learned in that seat that were maybe different from what you expected going in?
That's such a great question. I would say in hindsight, it's the fact that I ran a global business, which means I had Japanese traders reporting into me. Now, the Japanese guy in Tokyo, you go visit, he had naked women on his Reuters screen, very well educated and all that. But you know what? He respected me as his boss. He would proudly introduce me to his Japanese friends as my boss. And he would literally cry when he would talk about his sick mother. So what it taught me is our vantage point and what our value system is. We have to be a little more broad. I had Germans reporting into me, French, Italians. And so what it taught me is, and again, it sounds like platitudes, but I feel very strongly about it. The greatness of human beings to do amazing things in all forms and shapes is amazing. That's what it taught me in hindsight. And again, throughout my history of Morgan Stanley, as I said, I joined when there were 1,800 people, maybe even less. When I left, it was 60,000 people. I had offices everywhere. That I got on an escalator to the moon. But when you realize that the power of people to shock you on the upside, to do amazing things, if you inspire them, is mind-boggling. And I think our problem right now collectively as a society is I don't think we have too many inspirational people. Not just politics, by the way, business as well. I don't want to get controversial, but...
Well, maybe give us some inspirational people.
There are, but yeah. Anyway, we won't go there so quickly.
Could you describe what your book looked like in 1993 and how did it evolve over time?
Yeah. Look, in 1993, it was a lot about human judgment. You had technology. Yes, I had Reuters screens. My kids have pictures of me surrounded by Reuters screens, trading. But I had a paper blotter. I wrote my tickets on a piece of paper and my trades. And then I gave it to an ops person who inputted those trades. And that ops person basically made sure that Goldman or Citi had the same data. I don't need to tell you that's a very different world where, especially in FX trading, where you're talking about razor-thin margins. It's technology is everything. Nanoseconds, you're moving billions and billions in nanoseconds. It's a very different world.
Yes, the joy of trade breaks.
Exactly. Exactly.
Did your approach to risk change over the years, or did it become just more sharply defined?
I would say what made me a successful trader is I understood very quickly that you're not going to make money unless you take risk. Let's be clear. But you need to get paid for the risk you're taking. So the calculus is, if I am wrong, how much am I putting on the table? And if I'm right, what's that asymmetry of risk reward? So that's very important to calculate that. So I never did carry trades where you basically pick up a few pennies for years and then some factor X occurs and you lose your job. That was important. But the other thing that was much more important, frankly, and it's very relevant right now, and I'd like to talk a little bit about why it's so relevant, is I did a lot of stress testing of my assumptions. Even at the end, I was running $1 trillion balance sheet across every asset class in the world. I had a lot of very smart people, everybody shilling for their own demand for balance sheet. But having your risk manager stress test your assumptions, that even if it's only 5 to 10% possibility that the assumption is wrong, if that happens and Morgan Stanley is bankrupt, it's too big. Whatever the risk is, no matter what the upside, it's too big. So for me, that actually over the years is what differentiated my approach to risk. Understanding what you're hoping to make. And no matter what your central case scenario is, if there's an unforeseen factor X, which, by the way, in '07, there was an unforeseen factor X that people forget. In fixed income, we knew Bear Stearns was in trouble, Lehman was in trouble, equities were making new highs. But in fixed income, we knew there was a lot of opaqueness and a lot of complexity to those mortgage securities that we cooked up. But we knew that the default rates that we were putting into our collective models, some of us knew, not everybody obviously, were going to be a lot higher than what the models were saying. And the recovery rates were going to be a lot lower. When you started looking at that, it blew your mind that the end was near. It ended up being '08. But in the summer of '07, equities were making new high in that environment.
When did you first realize?
I actually, way too early. And in fact, John Mack took me aside and said, "You're too negative." And his thing was all about leadership. I used to say, the sky is going to fall. And frankly, that's what saved my reputation. Stan Druckenmiller, I used to call every week and say, the sky's going to fall. And he remembered. So when the sky did fall, there's a difference between you need a change when something like that so dramatic happens. I started looking at the numbers way too early. And for me, when I looked, and there was a meeting at the Fed, actually, and John used to hate going to these things, so I went. I'm the only woman in the room. There is Lloyd Blankfein, Jane, all the giants of the finance world was there. And I think Lloyd is the one that said, "I am cautiously optimistic." This is in '07. And I said, "I'm not." And I said, "You should come to Morgan Stanley and you should look at all the leverage that we have put into the system, we at Morgan Stanley. We can give you what our market share is. And then you go to Citigroup, you go to Goldman Sachs, you will get a pretty good idea. There is enormous leverage in the system." And I'll never forget, I won't tell you his name. The guy looks at me and he says, "Last I checked, the SEC regulates you. Go tell them that story." So I think we're in a very similar situation, by the way, not to get ahead of your questions, but I think maybe I'm early. But when you ask, when did you realize, I have been worried about inflection points for at least a year, if not longer, which means my personal portfolio has missed the last 25% of the growth story. But I don't like the asymmetry of risk reward. And what I mean by that is if you step back and people ask me, what will the Fed cut? This was before they cut 50 basis points. And in fact, some of you were at Denver. The question was the Fed 25 or 50 basis? Who cares? It doesn't matter. You need to step back and say, is this the end of a mega cycle? And the mega cycle is the one I described. I joined Morgan Stanley. Overnight rates were 21% on their way to zero. Risk-free rates of return were 15%, 1.5, 30-year treasuries on their way to 2%. 60-40, 40-60, it didn't matter. That is going in reverse. And I don't know whether it's going to be, again, if on a scale of 1 to 10, the mega cycle is at 9.5, which I believe it's closer to the end than the beginning. It has you look at your portfolio very differently than if you think it's at 6. I'm not pontificating that I'm right and the market is wrong. But we need to understand if that assumption is wrong, you're going to have binary outcomes in your portfolio. They're not going to be off by 10%.
Where do you think the risks are?
The last decade of growth has come through leverage at the sovereign level of every country, including our wonderful country, and at the private level. You look at, I think the dislocations in the private equity business are not as evident because it's not mark to market. But a lot of these investments were made when interest rates were zero. That is a bit problematic if the assumption is that the cost of capital isn't going to stay cheap. It's going to go higher. I think ultimately I look at the growth that came through leverage. The U.S. government right now, and this is still, I think, the best country in the world is a relative place. People talk about EPS and the multiples and this and that. Nobody talks about in August, by the way, the budget deficit for this country was supposed to be $280 billion for the month. Budget deficit for the month. It came out at $390 billion. It's the fourth largest miss in history. Did you see any headlines about this? So for me, we're not looking at the right things to reaffirm it's still a growth story, if you think, but when you look at history, enormous leverage, there are two ways to get out of that: repudiation of the debt or inflation. And we all know which way the government is going to go. It isn't going to be repudiation. They're going to inflate their way out of it. And so again, in August, the headline, inflation is under control. Services inflation and rent was up 5% annualized, 5%. And again, when you think about the anger, and people talk about the division of America, your average American is sliding into poverty through inflation. They can't pay their bills. Maybe I'm exaggerating a little bit, but that's where the anger is coming from. That for them, inflation isn't 2%. So we should look at the right things. And if you say then, you can still make money in this environment. So if you say we're at the end of the cycle, that they're going to choose inflation to reflate their way out of it, there are ways you can make money. By the way, the positive thing in this country, the positive thing is we're reshoring manufacturing, any kind of manufacturing or creation of things. It's coming back to the U.S. That's in the next 10 to 20 years. That's not disinflationary. The price of cement isn't going to go down. You're building factories that exist in Taiwan and in China. That's not disinflationary. It's a great story. So for me, I own, in addition to T-bills, because that is, as long as you don't have too much duration, in my own portfolio, and I own inflation-linked things like commodities and a few other things. But I don't own growth stories where in any capital asset pricing model, if you are a great growth story that you're going to see the cash 10 years from now, if you think that denominator is going to stay where it is today, I think that's the wrong arithmetic. So I don't like that story. But I'm willing to pay the price of being wrong. And the last year it was wrong.
Let's go back to 98 because you were in the seat then. Yeah. And how did you respond to the abrupt shock? There were some signs, but not.
98 or 7?
98.
98. Oh, wow. Actually it was profligacy on the part of governments that don't have a reserve currency called the dollar. It was the Asian crisis. You had countries basically going from everything is fine to bankruptcy. If it weren't for the IMF, there would have been. So again, being in a foreign exchange market, you saw when the market loses confidence in your ability to manage growth in your country, they take the money away. And so currency is lost. Forget 98. People forget right now, Argentina, the Argentinian peso went down 90%. 90%. Turkish lira went down 50%. This is not 98. This year it happened. So for me, coming back to America, it is the most powerful country in the world. It matters enormously to the world. Right now, again, I look at the numbers. Our non-discretionary spending, our budget non-discretionary spending is exceeding tax revenues. Think about that arithmetic a little bit. And we talk about, is Kamala going to win? Is Donald going to win? I'm not going to go there. But neither one of them are going to actually face the arithmetic problem this country has. They're both going to put in at least $2 trillion budget deficit. They're going to spend it differently on top of $34 trillion that we borrowed already. And when you think about 75% of the $2 trillion is non-discretionary, Social Security, Medicare, Medicaid, my generation. It's about us. 2%, I think, the most recent, 2% is going on education for the next generation. So for me, who's going to win and who's going to lose, there's a lot of pyrotechnics around that. But they're not going to face this issue of we're spending a lot more money than we gather. And Donald is saying he's going to cut taxes. Yeah, as they say in Latin. Yeah, how? Anyway, that's...
How did the growth, or how has the growth of algorithmic and high-frequency trading impacted liquidity and price discovery in the FX market since your time at Morgan Stanley?
In the FX market, in the equity markets, again, I was there when the equity floor used to be pretty similar to the foreign exchange business. So the way all of these markets have changed, you're talking about technology, which you're unifying globally liquidity, where it goes from point A to point B in seconds. So if you look at a bell curve, in the middle of that bell curve, liquidity is much better. You can do hundreds of billions of dollars much faster. But the tails got a lot fatter, the fat tail risk, which is when it goes wrong. Ken Griffin is brilliant and he's making a lot of money. He'll turn off his machines if it's not working. At Morgan Stanley, if you were a primary dealer, you were obligated to make a price. And in exchange for that, the government kind of stood behind you. So for me, we've made trading much easier. It's grown exponentially. But the complexity, if it goes wrong, again, factor X, if it goes wrong, none of us know how to fix it. I was running businesses where if something went wrong, I knew how to fix it. I knew how to say, stop this, do that. Or talk to the government. You think you call the Fed and they're going to have any more answers than you do? I think the world in general has grown exponentially, but it's much more complex and it's much more opaque. And the antidotes to those problems when they come aren't going to be that clear. Just an example. Again, I am amazed, and I don't know why so much ink is being spilled on nothingness. The nothing burger, I think that's how you say it in America, nothing burgers. The UK gilt market, basically this is a big capital market. UK gilt market in 2022 went down by 25%, lost quarter of its value in days. Price gaps that we haven't seen. When I say things are unprecedented, given my age and my experience, that should matter. So these were appetizers for what could come.
What was the catalyst that moved you from TradFi to DeFi?
The catalyst is John Mack decided that he needed a change of leadership. Again, what's really interesting about that catalyst is go back to you don't get shoved off the ledge voluntarily. 7 weeks before John decided he needed a change of leadership, 7 weeks before that, there was I think, Wall Street article, I'm the next chairman and CEO in waiting. And I remember I came home and I said to my husband, I have zero interest in that job. Zero interest, because president is the last line job that you have. So anyway, I left Morgan Stanley, very unpleasant, very painful. I thought I'd go back and become an architect or something. And I love markets. I started managing my own money.
Hold on a second. Architecture?
Yes. So I love I'm Greek. I love beautiful things. Great design. And my ex-sister-in-law, we're very good friends, who is an architect, she says, you think you're going to become an architect and build beautiful things? You don't know how many ugly things I'm being asked to build. So it disabused me of that notion. I'm a Renaissance person. I was a literature major. But again, luck in what I'm doing today, and the question people ask, why are you doing this? The digital asset space. We renamed it because cryptocurrency is not a good word anymore, so it's digital assets. I had told the headhunter I don't want to go on a board of, JP Morgan or any of those boards. I want to go on boards where I can make a difference. So I get a call to go to Silicon Valley to interview for this company that has a huge balance sheet, Ripple. It has a cryptocurrency, blockchain technology company. This is 2017. Their token, XRP, was 1 cent. In May of that year, it went to 18 cents. So this little Silicon Valley startup had billions of balance sheet from January to May. So of course they had money to spend. And I had said, and this is again, keeping an open mind in how you view the world. I was where Jamie Dimon, who was also our business school classmate, where he would say, this is all a bunch of, I don't believe any of it. And that's what I said to the headhunter. I said, look, blockchain technology will change the world. Distributed ledger technology, no more out trades. We both looking at the same data. But crypto, I don't believe in that. And thank God he says, go listen. It changed my life. So I have a company. It's a small company. It's in the digital asset space. I'm talking to people that are arrogant enough to think they're going to change the world, which means they will, just like we did in our youth. But I don't look at this revolution the way you read about it. Buy Bitcoin and you'll be rich. Maybe. I think given my view on inflation, yes, it is a store of value. But the real revolution is we're rebuilding the pipes on which, not just finance, on which exchange of value happens. We're tokenizing real assets. You can tokenize your home. You can tokenize oil. And those tokenized assets can move. You and I can exchange value, not just money value, without a bank account. That's a very big deal. Very early. Lots of shysters, as I said in Denver. I was talking in Denver about this. Lots of shysters in this business, but there are brilliant people that will change the world, and they're doing it. When I was at Morgan Stanley, raised my hand to hire people in structured credit. You could get the best brains from MIT, Stanford, the best, to come and structure trades. They have no interest to go to Morgan Stanley. It's still a great firm. They're writing code as we speak that will change the world. Some of the best minds in the world. And they can be in Nigeria, they can be in Kenya, they can be in South Africa, in France. That is something actually that is, I feel, spectacularly interesting.
So we have our first question from the audience. Zoe, what do you think about wealth management culture vis-a-vis Morgan Stanley and Goldman, et cetera?
So there is and again, the firm got lucky, and again, John took a risk. At that time, when basically Morgan Stanley was a great investment bank, I would say arguably better than Goldman, but we didn't have enough capital through retained earnings because agency fees are not as good as prop trading. Goldman was brilliant. So at those years, Goldman was getting capital through retained earnings from trading. They didn't need to think about the future. They were going to do prop trading, and the investment bankers were doing their bidding. A bit of conflicted business model, I might say. Morgan Stanley, because ironically, we didn't make enough money from investment banking. John Mack was running a fixed income division when it was it was the afterthought. That's where the fights were between Mack and the bankers. He had this brilliant idea, the bankers actually had this brilliant idea that we should go to Phil Purcell and buy Dean Witter. Yeah. Now, and again, for me, this is where it's a shame that John and Phil did not see eye to eye. It is what it is. But it was a brilliant idea. And in fact, we begged. Phil didn't want to do this. He said, look, the culture, of those institutions, it's all about process. As I said, they used to call them our bankers. Stupid. I said, this is a guy out of Sears, Roebuck and Company, created a company called Dean Witter that is a merger of equals with the almighty Morgan Stanley. How is he a stupid man? But anyway, that was brilliant. The Civil War was painful, but it was a brilliant merger. Gorman, in fact, John and I hired him because at that time, actually, and I'll never forget, he was fired actually by Merrill Lynch. And we were interviewing him, and I was so impressed with his thoughtfulness. And frankly, when we did hire him to run Dean Witter, and of all my direct reports, the bankers that come in, all kinds of brilliant ideas, he'd come in with 3 things on his sheet. He wouldn't leave until all 3 were talked about and what we're going to do next. That's what Morgan Stanley needed as it actually grew the business that was fee-related business. And he did a brilliant job. Brilliant job. Although, and I don't know, frankly, I'm no longer an insider, but I understand the guy is ill, the heir apparent. And I know Ted Pick. He's a great, brilliant man. He's maturing. And I think you need to have someone that understands complex businesses. And Morgan Stanley, being an investment bank, still has a lot of complexity in its business. So I think they did the right thing.
We have another question from the audience. In my role as a CIO of a family office, I'm trying to asset allocate. How do you think about weighting commodities, gold, crypto, and different things?
First of all, I don't envy your job, number one. Because again, when you think about all the CIOs of my generation, or me, because at the end of the day, when you run a place like Morgan Stanley, you're an asset allocator. You're allocating assets, whether it's human beings or balance sheet. What a great job. A monkey could do what we were doing. So number one, you need to understand, and how do you educate your bosses, whoever that they may be, the asset owner, if you're running a family office, that it's not your God-given right to make 10% risk-free. That ship has sailed. So you need to educate the endowments where Harvard is spending like there is no tomorrow, not understanding they're not going to make actually more than 5% unless they're taking enormous risk, however you call it. Number one, we have to reset what is reasonable for the next few years, because I'm telling you, the big money gets made after the deluge. My favorite example is one of my best trades was I bought B of A stock in 2008 after it collapsed and I forget the exact numbers, but maybe $8, $8.50. It went to 6, 7, but it's my money. Nobody was going to fire me. I did more. Why? I know balance sheets. You could have bought a company that was making billions of dollars every quarter for 50 cents of its book value. You needed 2008 to get that opportunity. It will come. So for me, you should, because you don't want to lose your job or any asset allocator, for me, the right assets, the right allocation is diversify across investments that need low inflation and low interest rates, growth stories, investments that actually are value investments. If you have a good factory and you have, as Warren Buffett likes to say, the moat. So you invest where if the underlying world changes, you don't put all your, what is diversification based on that assumption. But again, for me, when I say I doubled my B of A position, nobody was going to fire me. It's easy. I wasn't accountable to anybody. It's my money. So for me, for all of us as asset allocators, we need to educate people that you're not going to get to make a lot of money when the market adjusts phenomenally, and it will. I don't know whether it's 5 years from now or 6 months from now, but you're not going to get those opportunities if you're putting 10-year money, you're locking your money up because private credit is the new thing. Maybe it's wonderful. But if you have allocation where you're giving liquidity away for 10 years, it's too much and it's for too long. I'm not saying don't. So that's how I would look at the themes.
What about gold and crypto?
I own gold, and the first time I bought gold is 2 years ago, because again, I was early. My generation buys gold. And by the way, it's a negative carry position. Why are you going to own gold if you can put your money at 10 to 15%? But 2 years ago, I bought gold. My 28-year-old son buys Bitcoin. So some of it is generational. For him, what's the difference between a bar of gold in the basement of JP Morgan private bank versus, I'm exaggerating, versus Bitcoin? Crypto, as I said, for me, the reason I'm excited about this space, it is a revolution. It's very early. It is the cheapest growth story of them all. But so I feel zero allocation to the digital asset space is the wrong answer. More than 2 to 3%, and that's what I say to people. More than 2 to 5%, if you really believe in it, of your net worth is wonderful. Give it to the adults in the room, which obviously we are. At least there are a few of us that are adults in this room. And focus on 95% of your portfolio that could be in deep.
Question from the audience. Do you think a liquidity crisis in emerging market currencies would affect crypto?
It's a great question. I don't know, but in the short term, it will affect it negatively because risk assets, when things go haywire, the correlation is one in the short term. But another reason I like that diversification in the portfolio is as correlations are very unstable over a longer period of time. And the bet I'm making is if you invest in a lot of those tokens, and again, coin sucks the air of the room, it's interesting. It's basically an inflation hedge. But all these other tokens where the token is a call to a network. And if that network becomes big and a lot of people use it, think of it as a mall, and you create basically in that network, you collect fees. Ethereum, people don't realize because Ethereum is the company that made in 7 years, $10 billion in 7 years, real money. Because a lot of people are writing apps and writing code on the Ethereum platform, so they're collecting fees. 10 billion. The only company that made it faster was Google, Alphabet. Meta, none of them did. So coming back to your question, I think the drivers of that world are very different, i.e., what are the regulators? They can put this industry out of business. That has nothing to do whether it's emerging markets or not. I think the ship has sailed. I don't think they can do that anymore, but it's a diversifying asset class on many different levels.
Question from the audience. Soaring debt is well known. What about other forms of leverage? Do you think it's just too much? Leverage is rampant in the current system.
There are all kinds of charts that are scary to look at. And again, I think ultimately I want to be very careful because I certainly am not going to be that person, the sky is going to fall and there's fire and everybody's. But when you think about the leverage, again, going to private equity or even VC, but let's say private equity. I grew up at Morgan Stanley where a huge private equity fund was $1 billion. And so you could lend to two guys and a dog that became the company. Now, if you are a private equity firm that has $60 billion, you buy companies that are already big, you lever them. I'm not giving you any secrets. You lever them enormously when interest rates are zero. So the numbers are there if you look under the hood. Credit card debt. The U.S. consumer, they're actually using their credit cards to pay their utilities. So that number, the slope of that curve is starting to look like this. So the numbers are there for everybody to look at.
So we've got another question from the audience. So what's your take on the U.S. versus Europe?
So it's such a great story and as a Forex trader, I was actually really amazed that it took so long. I don't know if the yen deleverage trade that occurred, what was it, a couple of months ago?
Yep.
A month ago. So you're talking about dollar yen went to, I forget the high, 160 from 140, like in days, if not weeks, maybe. This is a country that borrowed, remember, the Japanese economy collapsed because the real estate, the palace in Tokyo, remember, was worth more than all of California real estate. That was, so huge bubble. It collapsed. The government wanted to reflate, again, huge debt, but they had two things that why it took decades for them, how do you say, the chickens came home to roost? 2 decades at least. They had local savings, enormous savings as a nation, and they basically had an ability to borrow. You had for a long time the government keeping interest rates at 0. And because of the world disinflationary winds, they could also, because inflation was also at 0 in Japan. And then COVID, the world changed. Again, deglobalization, because remember, globalization was disinflationary because the friction of movement of goods and capital goes down to 0. Where we're deglobalizing. So all of a sudden, their inflation was going up. They wanted to raise interest rates by 25 basis points. Japan is still a big economy, an important company, 25 basis points. The market forced them to say, uncle. They stopped. That is to me an appetizer of how quickly it can change. I would say that for Japan, they're not going to buy on the balance. The biggest foreign buyers were the Japanese and the Chinese. Neither one of them are buying on the margin, clearly. So I think those are markers as to what happens when people are no longer willing to buy the story that you can keep interest rates at 0 with inflation ticking up. And that's why for all of us, I would, if I can leave you with any advice, is look at the inflation data, not just the headline, because I'm amazed because I do look at that. And services went up, as I said, 75% of your average American spends his or her money on food, petrol, and rent. That inflation isn't 2%. And so when you start looking at those numbers, we should all worry inflation isn't going to be, it's going down to 2%. I don't think so. Could be wrong.
Question from the audience. What do you think about Bitcoin as a diversification tool against inflation?
For me, when you look at the deluge of any markets, nothing is safe. Every asset goes down, clearly. Some less. If you're in the defense business, maybe you'll go down less than if you're a growth stock. But when the dust settles, and that's what I'm talking about, so yes, if tomorrow you read that NASDAQ is down 5%, knock on wood, we don't wish that, but I can tell you, you don't need to call me.
Right.
All crypto is going to be down, if not more.
Right.
Clearly. But it's when the dust settles, when you start looking, now that we have tabula rasa, where am I going to put my money? I would say 0 allocation to risky asset is the wrong answer. It is the best priced risky asset in the world, in the sense that, again, a symmetry of risk reward. When you say something is a risky asset, and it will be for the next 10 years, just to be clear, when you say it's a risky asset, you had downdrafts in price of 50%. Bitcoin, Ethereum, 50%, 50. But the upside, there's a lot of tech bros that are billionaires, is 100x. That's what I call a symmetry of risk reward. Don't put your kids' education in Bitcoin and crypto, but it's that asymmetry of risk reward as long as it's price risk. And by the way, I call our portfolio liquid VC because, again, those tokens are claims on networks. Liquid VC, you can get your money anytime. That's the transparent. You see the price. But it's no different in terms of its price risk than VC or private equity investments. The only difference is not mark to market. If interest rates go up, let me tell you, your private equity and VC portfolio growth a bit of trouble. So the only difference is you're accepting the market risk. If anybody tells you it's a no-brainer, it's a no-brainer if you, again, it's all about asset allocation. I'm preaching to the choir. The asset allocator, par excellence, the job is to allocate the right amount to the right asset class. So that's why I said zero allocation is the wrong answer. It shouldn't be so little, because some people say, well, how about 50 basis points? It's not enough where you care to be educated, right, that you actually call me and say, what's going on? If it's 2%, you're not going to be sleepless at night. You're not going to sell your Park Avenue apartment because you put too much. Only you know what your situation is. So that's why, for me, finger up in the air, it's 2 to 5%. You care enough, but that 2 to 5%, if you put it in when it was nascent, by the way, we're actually talking to somebody in the Middle East, as everybody who needs money goes to the Middle East, clearly. And we've been talking to them, Bitcoin, and again, all of them go up and down the same way. Remember, Bitcoin was at 70 and then it collapsed back down to 50, whatever. Last week, the week before, it was 58. It's at 62 this morning. So when I looked at my screen this morning, all the tokens are up 5%. So if the market starts adjusting to this asset class, the price isn't going to happen in years. It'll be in months. And so you can get in here or you can, but the point is it's not get rich quick schemes. As I said, the focus has to be on 95% of your portfolio. That's where the focus has to be.
That's all the time we have. Zoe Cruz, thank you for joining us, and thank you for sharing your wonderful insight. Thanks for listening. If you enjoyed the podcast, please leave us a review on Apple Podcasts or share it with your friends. Thank you.